This material is made available to you by or on behalf of the University of Melbourne under Section 113P of the Copyright Act 1968. It may be subject to copyright. For more information, visit the University Copyright website.
Time to start. You can do most of things right now. Another one. All right. Let me see. All right. Let's start then. Welcome to week 6. Again, we are still continuing the discounted cash flow investment analysis, and we are connecting tax today. Today, our main focus is tax. So what are we going to talk today? We'll be talking about negative gearing and types of taxes, tax deductions, depreciation calculation methods. What are the main depreciation calculation methods? Use of tax shelters. What's the importance of tax shelters? And tax rates, capital gain tax, very popular one, and incorporating income and capital gain tax into the investment analysis using capitalization. Right? So at the end we will do discounted cash flow investment analysis to obtain an after-tax IRR. If we have enough time, we will do it. All right. First, start with negative gearing. What is negative gearing? And what is the importance of that? You might have heard about negative gearing many times. It was a big topic last year during the election. I'm not bringing the politics here, but it's a macroeconomic factor, political environment, government policies. So one party told before the federal elections they are going to abolish the capital gain tax, negative gearing. And the other party says, no, we are not going to. And then the party who said, it's a Labour, say, we are going to abolish the capital gain tax. And they said, whoever bought the investment properties wouldn't be affected, but who was going to buy new from 1st of January, that will be affected by 1st of January. So I know that few people rushed to buy properties before 1st of January, before the election, assuming that negative gearing will be affected. So yeah, so it's very politically sensitive topic at that time. Right, what is negative gearing? Yeah.
So like if you've got an investment property, the secondary residence, the difference between the rent and the mortgage can be put on as a taxable deductible item on your income. So if it's like between $1,000 difference, you can take that off your income potentially.
That's right. That's right.
And not only interest, your agent pay building depreciation, and the insurance also can deduct from
Total expenditure. Yeah. Total loan repayment as well. Interest repayment. Interest payment, not loan repayment. Interest payment as well. Right. So negative gearing occurs when the investor's total expenses and interest on loan, it means interest payment, are not covered by the total rental income. Right. The total income is not enough to pay the total expenditure, including loan interest. Right. It is usually achieved as a result of the size of the property or loan taken. Right. People are trying to get the negative gearing. So the main factor is the amount of the loan. If you have a bigger loan, you have to pay big interest, large amount of money as interest. So that's a big expenditure. So your expenditure goes high up. So income is fixed. So you're not making any money. Right. Then why people buy investment properties? If you're not making any money, if you make negative gearing, why people buy investment property to make a negative gearing? What is the advantage? Exactly. One thing is you can reduce your tax payment, and then investment property is you are thinking the future capital gain. You put your minimum equity into investment properties, get a bigger loan, and pay the interest. If you can pay only interest, that's better. Right. So you get a better return on your equity after a few years, probably 10 or 5 or 10, 15 years, you'll have higher capital gain. Right. We'll talk about that one. Right. When you talk about negative gearing, we can talk about positive gearing as well, plus neutral gearing and negative gearing. What is positive gearing? Simply, your total income is enough to cover your total expenditure, and you have excess. Right? So, for example, your total rental income is, assume 100,000, and total expenditure is 40,000. So, net operating income before interest, 60,000. Now you have to pay the interest on your loan, borrowing. So, say it's 40,000. You have a net operating income of 20,000. So it's positive cash flow. That is plus. So you have excess cash. That's positive gearing. What is neutral gearing? Same example. You have 100,000 net rental income. Total expenditure is still the same, 40,000. And net operating income before interest is 60,000. But you have a bigger loan and you have to pay a higher interest, big amount of interest. So 60,000. At the end, you don't make any money. So it's neutral gearing. Net operating income is 0. Negative gearing. Same example. Total rental income is 100,000. Total expenditure 40,000. Net operating income is 60,000. So now you put an even bigger loan. So you have to pay 80,000 interest per annum. So your total income is not enough to pay your total expenditure including interest. So you are losing money. You have negative gearing of 20,000. So how that negative gearing will help you to pay tax, less tax. We continue that example. If it is positive gearing, you have other incomes as well. That's your investment property. And say you have some other income, your main income, salary or some other income. Your total salary is 120,000. Net cash flow from property 20,000. And total income now, your total income is 140,000. So when you have investment property, you can claim your tax. We will talk about later. You have allowable tax deductions, 20,000. So your taxable income is 120,000. So you'll be taxed on 120,000. Right. So neutral gearing. Now you have the same salary from your job, for example, 120,000. So you didn't get any income from your investment property, but your total income is 120,000. Your deduction is 20,000. So your taxable income is 100,000. Now you have a property with a negative gearing. So now we calculate your total income. Your total income from salary is 120,000. From your investment property is minus 20,000. It's a negative gearing property. So your total income is reduced to 100,000. And again, you have allowances, 20,000. And now your taxable income is 80,000. So you pay tax only on 80,000. So keeping that negative gearing investment in your portfolio, you pay less tax. Right. While you are paying less tax, you keep that property to increase their capital value in long run. So you get a bigger loan, as much as you can, say 95% or 90% loan, and you pay high interest. And you pay less tax, but you put less equity on your investment property. But the property capital gain is, so property value will be increasing in the future, so you'll get a higher value. When you sell it, your return on equity is higher. Right. That's the purpose of, that's why people are very interested in negative gearing properties. But, see, advantages of negative gearing. Negative gearing allows people to invest and build wealth, but less tax. If you have lots of money, you don't pay, say you have 3 million in your cash, you can buy different investment properties, not just 1 million properties. You can borrow money and borrow as much as you can, make a negative gearing, and reduce your tax payment and build a wealth. So you have 15, 20 properties, and their all value goes up. Value of all of them goes up. Right. So you can build your wealth. The negatively geared investor has used less of his own equity, which can be put to work in other investments. That was what I was talking about. Right. As long as he can afford to cover the original shortfall or negative cash flow from the investment property, he benefits from lower rate tax while waiting for the property to appreciate in value. That's the important thing. If you are in a very tight cash flow, it doesn't really work. Because you should have excess cash to pay the shortfall. Right? If your total income is not enough to pay your total expenditure plus interest payment, then you should be able to pay it by yourself from your pocket. So you have to have a good cash flow. Otherwise, it doesn't work that. Right? Returns are maximized because you have used less on its own money. It means less equity. Right. In a rising market, we call bull market, rising market, all works really well. Because we are expecting property values to go up. So in rising market, it goes really well. But what happened if the property market is going down? If we are facing a downturn of the property market, that's a problem. That is where investors get into trouble. Right. Let's talk about that. You invest money expecting that property value goes up, right? But in the falling market, the property value goes down. What will happen? Banks give you a loan into a loan to value ratio, say 90% or 95%. When the property values goes up, the loan which bank has given to you is more than the value of the property. Right? So bank will say your loan to value ratio is too high. You have to pay some equity to the bank. We'll do the example so it will be clear. Right? Then if you don't have cash in your hand to pay that extra equity, then what will happen? Bank will sell their property. If bank could still recover his loan with the sale price, bank will sell your other properties as well. Right. That's nightmare, right? So you have to be very careful where you are at the market when you buy investment properties and where the market is heading to. Right.
In a bull market, when you still default despite the fact that the value is going up,
Yeah.
and the bank liquidates the asset,
Mm.
and then will they return some of the money back to you?
Yeah. If the bank get more money than their loan, of course they will return it back. Yeah, of course.
So even I don't default, I pay every month mortgage. If bank ask me pay the ratio,
Yeah.
the gap of the equity, I couldn't afford the equity, they will sell my property.
Problem.
Even I pay every month mortgage,
Still. Because bank has its regulations.
every year you do the valuation.
It's not every year when the market, they evaluate the market. Then they will decide
When
it.
the market goes down,
Yeah.
the valuation.
Yeah. In a falling market, an investor's return can be greatly reduced and losses become more likely. Right? If the value of the property falls close to or below the loan amount, the bank will require more equity from the investor to restore the loan to value ratio. That's what I was talking about. Right? If the investor can't supply this extra equity, the bank may force a sale. If the money recovered is less than the loan amount, the bank may seize other asset of the investor. Right. Right. Let's go through the example. Okay. Property purchase price at the purchase. The price of the property is 1 million. Loan to value ratio is 95. And then investor's equity, how much is? 5% of 1 million is 50,000. So loan amount is 950,000. So bank is happy to give you 950,000. Right? So you borrow 950,000. Right. And then after a few years, say after 5-6 years, property market doesn't perform very well and market is falling. It's bear market, I would say. Right? So now property value has dropped down to 900,000 from 1 million to 900,000. Loan to value ratio is still the same. Now, how much is the equity? 45,000. Right. How much is the value that bank could give you? A loan amount. The bank will only give you 955,000 loan. But bank has already given you 950,000. So nearly how much? 95,000. You have borrowed you have borrowed 95,000 more than you are allowed to give. So bank will say you had to give 95,000 because we had to make the loan to value ratio. Pay more equity to run the loan. Pay 95,000 to the bank as equity. If you can't pay extra 95,000, then bank will sell your loan as a property. If bank couldn't sell this property, say for 855,000 market, not many people want to buy that now. Bank managed to sell it for say 755,000. Banks still need more money to recover. Bank will force you to sell other properties as well. Right. So you need to understand. Negative gearing is good as long as you maintain the loan to value ratio and you have extra cash and you know where the market is heading to. Right. When you do those things, you have to have a good understanding of the property market, and economic condition. All right. Any question with that? Yeah.
Since your property is 855,000, but you have paid some loan, will he give the money back to you?
Think about you pay only interest. Then you haven't paid any capital. So you got the interest only loan, for example. Right? To make a negative gearing, investors is very much to get interest only loan.
So they don't get the balance and interest on the whole get it.
So it depends on the loan. So normally you are an investor, you are looking for a negative gearing, you are more likely to get interest-only loan because you pay less equity. If you repay the loan amount, means you put your equity. Installment will be higher. Right? Yeah.
From what I know, the negative gearing is a government policy, correct? So it's the government who decides, okay, we are using negative gearing.
Yeah, we can say, yep.
And
Tax policy, huh?
it works better in a bull market,
Yep.
based on what you said. And for the last 2-3 years, property prices are going down, but there's still negative gearing. Don't you think the government should...
Last 2 years, yeah, this year and last year, yeah, slightly. So, still, we couldn't see the big fall on the property market. Dropping down, last year it was stable, very stable, and slight drop, not a big drop. This will happen if market has a big drop. And depend on the investors, how much equity they have paid, how much cash they have to pay the equity just in case.
Would it be like, so the government would reverse the negative gearing if the market is bear market?
Then it will be a big issue. That will be even bigger issue. Then almost like all investors will be in big trouble, even though they can pay the capital extra equity. That will be a big issue. Right.
When is the time point for the bank to say, oh, I have to reassess your property to see?
It depends on the bank. If market is falling really down fast, and then if they can see that people are getting default, they're not getting enough property income, then they'll start thinking about it. There's no specific time frame.
You mean default, that means they couldn't pay the balance at the end?
Yeah.
Okay.
Yeah. There's no specific time limit that bank will give that, and that's all right. Good. Now, another important part is tax. Taxation. Very simple common question. Why do you pay tax? Why government charge tax? Why? Why government charge tax?
So we have roads, we have schools, healthcare,
To-
anarchy.
To earn money. That's the government main income. To all the infrastructure, welfare, and everything. Right? That's the government main income source. Right? To do everything. Plus, and government use tax as a tool to encourage or motivate some sectors and demotivate some activities. It's a good controlling tool for different activities. Right? For example, government want to restrict or limit buying properties by foreign investors. They put extra tax on investors by old properties, used properties, extra stamp duty. So that government used that tax as a tool to discourage some activities. And again, and recently Melbourne CBD had apartment has a big issue. Most investors, especially foreign investors, bought properties, apartments, and they did not live in there, and they did not lease it out. So they keep those as holiday bungalow. When they travel to Australia or Melbourne, they stay there. And they didn't want to lease it out because people believe the tenant will not look after the property. Right? And money wasn't the problem for them. And there are quite a lot of vacant properties, apartments in the city. So as I remember, this January or last January, from last January, government introduced a tax, 1%, vacant apartment tax. If your property is vacant for more than 6 months, government will pay charge a tax, probably 1%. Right. So that tax, government use that tax as a tool to encourage people to lease their properties out. Right. So that's another usage of taxation. Right. What are the fundamental principles of taxation? There are some fundamental, basic principles of taxation. The one should be neutrality, efficiency, certainty and simplicity, effectiveness and fairness, and flexibility. You can find different things, but these are key. Right? If you have done finance or taxation, you don't those things. What is neutrality means? Taxation should seek to be neutral and equitable between forms of business activities. So everyone should pay tax. It should not largely vary depending on the business activities. Right. Efficiency. Compliance cost to business and administration cost for government should be minimized as far as possible. So if government has to spend more money to charge tax and manage tax collection, it's not really worth. Right. So then government earn money and they have to spend significant amount to maintain and collect it. So government wouldn't get the good benefit of this tax money. So it should be very efficient. Right. And certainty and simplicity. Tax rules should be clear and simple to understand so that taxpayers know where they stand. Your income is 100,000, that's what you pay. Very straightforward. There are some tax systems in some countries, I know. Even tax experts can't really understand. They have arguments. People don't really understand. It's very complicated. And people don't really want to pay because they don't know. They can't really understand. So if they have to pay the tax, they have to go to tax consultant. And it's very complicated. So it's not really good. Right? It makes it easier to understand the obligations and entitlement. Effectiveness and fairness. Taxation should produce the right amount of tax at the right time while avoiding both double taxation and unintentional non-taxation. So we don't charge tax on tax. Right? That's the key. And tax should be equal. You cannot exempt one sector unintentionally. If you want to encourage, that's different. That's intentionally. You can't avoid one sector or two sector unintentionally. Right. In addition, the potential for evasion and avoidance should be minimized. There should be a good system that they should be able to track every people and they pay the tax. And flexibility, that is also important. Taxation systems should be flexible and dynamic enough to ensure they keep pace with the technological and commercial development. New technology. You can pay tax online from the phone now. So that's really good. All right, move on. Investment and tax. Why tax is important in investment? Because investment involves acquisition of income producing properties, and that property produces income and you have to pay tax on your income. And tax deductible expenses including outgoings and finance cost, etc., loan interest. So when you have investment properties, you have tax deductions, loan installments, interest payments. So they are tax deductible. So if you are investing in property, you have to have a good understanding what tax benefits you should be able to get. Right? Otherwise, you will not be able to get the maximum benefit of your investment. Right? And negative gearing available. What are the negative gearing? How can you get the negative gearing? Right? Those sort of things. And tax depreciation allowances reduces the income tax payable on property income. Tax depreciation, which is different from financial depreciation. If you have done accountancy, financing, you do depreciation when you do P&L account, profit and loss account. That rate is slightly different from tax depreciation. So we'll talk about it later, right? And capital allowances reduces income tax payable on the property income. Depreciation, capital allowances, we'll talk about it. And capital gain tax payable on ultimate disposal. When you do discounted cash flows, you sell your investment property at the end of the investment period. So if you sell your property in a higher value, you have to pay capital gain tax. So how do you calculate the capital gain tax? Important, right? And investment properties involve both income tax, including GST, right? That's why you need to understand tax if you are involving with investment properties. What are the main types of tax which is related to investment? A land tax in Australia, we're talking about in Australia. Land tax is a state tax, differ in different states. We talk about Victoria. And stamp duty. When you purchase a land, property, you have to pay stamp duty. And good and services tax. Income tax, capital gain tax. As we'll talk about later, capital gain tax is a separate tax. Who said it's a separate tax or it's a part of another tax? Capital gain tax. Is that a separate tax? Yep.
Maybe income is included in your income tax?
Yeah. Capital gain tax is a part of income tax. It comes under income tax, but when it comes to capital assets, we calculate the capital gain tax separately. But the rate is same as your personal tax rate. It's not a different tax, it's part of income tax. Yeah.
Among these five, is the first two is state and the other three are federal?
Yeah. 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 Right, land tax. Land tax is an annual fee charged on a sliding scale and paid on a property except principal place of residence and a farm. Right. If you have investment property, you have to pay land tax. But if you buy a house to live, a place to live, you don't have to pay land tax. Right. Most investors, for residential investors, they try to buy investment properties with a small land. Because if the land is bigger, you have to pay higher tax. So it reduces the net operating income. You pay higher tax. Right? So they tend to buy properties with small land. Yeah. Strata pay the tax. Yeah. Strata has tax. Yeah. Yeah. Exactly. Yeah. You pay the strata amount, body corporate, and body corporate pay the flat tax. Body corporate. Yeah.
So that was my question. Do you pay tax based on gross floor area or just the land it sits on the floor?
It's a percentage based on your floor area. Yeah. Yeah. Good question.
Townhouse mean inside of one level living one family, level two living another family, they pay land tax. How calculate?
Body corporate calculated. They have body corporate. Yeah.
So it applies to all kinds of properties, including strata property.
Yeah. Strata that has to pay the land tax to the government, and you pay part as part of the body corporate.
So it's just accounted by this amount of fees, we just over 250,000, just you have to pay.
Yeah. Yeah, exactly. Right. This is the rate. Right. The taxable value of property is based on a council valuation performed every 2 years. The city council value the land and then get the percentage and send you, this is the tax. It's like your rate payment. Right. City council value your property every 2 years, and then your valuation will be the same for the next year, and you have to pay the rates based on that valuation. Yeah.
If you buy a farm and then get it through a planning scheme amendment, do you have to pay land tax when it changes zones?
Now, if you use it as a farm, you don't have to pay.
So it's a use, not what you're purchasing.
What do you purchase it for? For a farm or subdivide and for development purposes?
Well, you purchase the farm
Yeah.
as a farm,
Yeah.
have it rezoned,
Uh,
and then develop it.
then once it's rezoned, it's not a farm anymore.
So you
You have to pay that.
the tax
Yep.
on the rezoning
Yep.
going through.
Yeah.
Sorry, so actually what is applied to both for the owner-occupied property and the
Owner-occupiers do not pay land tax. The PPR means principal place of residence. It means owner-occupier. Your main residence. You don't pay land tax on land residence.
maybe for investor, if he or she has three investor properties,
Uh-huh.
so validate to the amount for charge just calculate by the total value.
So if you have 3 investment properties, for example, that's what you say. So you have to pay land tax for 3. And you are living in a separate house. So you don't have to pay land tax for your living place. Any other investment properties you have, and which land value is more than 250,000. Yeah.
So which means the rate we will charge goes on the aggregation amount for the total value of land,
Yeah.
just like the income.
Yeah. Value of the land. Yeah. Yeah. And therefore, the taxable value of the property should be consistent for the next 2 years. Yeah. So, if it is more than 250,000 or less than 250,000, now these are the rates between 250 to 600,000. So, best thing is to check the rates. Go to the website because these rates could change. Right. Go to the websites, government websites. They give the accurate rate all the time. Even the income tax rate changes, right? So go to the website to get the current actual rate. I always recommend you to go to the website. Right. Next one, stamp duty. Stamp duty on a property purchase is paid as follows. How? Its dutiable value is less than 25,000. You have to pay 1.4% of the value. And it's 25 between 25,000 and 130,000. 1.4 up to 25,000 plus 2.4 above that. And between 130,000 to 960,000, 1.4% up to 25,000, 2.4% from 25,000 to 130,000, and 130,000 to 960,000, 6%. Same as the others, more than 960,000. All right, move to the next one. Goods and services tax, GST. You have to pay GST on construction cost, commercial rental payments, agents fees for all property types, and all commercial property sales taxed, exception when property is sold as a going concern. I'll talk about it. And residential property sales tax only if the property is brand new. If you buy a brand new property, property is only property is brand new, then you have to pay GST. But there are some exceptions. Residential rental payments are GST free. Land tax, stamp duty, GST free. Of course, no one can charge tax on tax, right? And council rates, against kind of tax. Planning and building application fees. Right. The next one, income tax. Company income tax rate is 30% flat. For small business is 28.5. And superannuation fund rate is 15%. Charities, tax-free. Right? And trust, if trust divided their total income among their trust holders, unit holders, that income is tax-free. Because then that full income become personal income, and the people have to pay tax on that income, right? And then trust keeps some profit income with them, then that income will be taxed at 45%.
So I am the beneficiary of trust, and that trust owns the property. In that
Yep.
case, I make the money through the trust.
Yep.
So I pay 45%.
If trust hold profit by itself without distributing your trust, distributing to you, right? Then trust has to pay 45% tax. If it trust distribute all the 100% profit to your trust holders, right? This class is the trust holder, and we the trust distribute all their profit to the trust holders, then no tax on trust.
But then I pay.
Then that's your income. Then you have to pay tax on your income.
What about I have a company, I'm the major shareholder, and the company is the beneficiary of the trust. Then I only pay the corporate tax rate?
Yep. Yep. Yep.
How does it work? If I set up a self-managed super fund and then through that superannuation fund purchase property, does that mean it's a tax dodge?
Good question. I have to think about it. I have to search it, to be honest. I didn't think about that too. Once again, you build your own superannuation fund.
No,
Sorry,
So
self-manage. Yeah.
setting up like a super with Host Plus or whatever, you set up a self-managed super fund to
Okay, yeah.
dedicate a certain percentage to property
Mhm.
and use that as an avenue to invest with your super.
Mhm.
Does that mean you're paying 15% tax as opposed to after post-tax then spending your salary on property? So,
I think it should be like that, 15%. I'll check again. Not 100% sure. I don't know. Good question. Yes. All right. Income tax, personal tax rate. Company tax is 30% flat. You don't have to worry. But personal tax rate. If you are a person in 2022, the rates, these are the rates. If your income is 18,200 below 18,200, you pay no tax. But make sure you do your tax return. Right? If you work, even though you get 18,000 less than 18,200, your employee deducts tax, and that tax will be sent to the Inland Revenue. Right? That's a rule. Regardless how much you earn, they'll deduct tax. We call pay as you earn. Pay as you earn. You earn, and employee deducts some tax and send it to the Inland Revenue. At the end of the financial year, if your total tax is 18,200, but you have still paid the tax. Right? So what you need to do, you have to submit the annual return and then show that your taxable income is less than 18,200. Then you'll get the tax refund, the amount you have already paid, the full refund.
Sorry for question.
Yep.
For the super fund rate, 50%, it means I need my super to do investment, then I get profit and pay 15%. Or the superannuation I get from my company, I need to pay 15%.
It's a superannuation fund.
Or only I invest for fund.
This is for the fund. This is for the fund,
Okay.
not for person.
The profit
Yep.
I get, I need to pay 15%.
Yeah. Yeah.
Okay.
Superannuation fund.
So
Yeah.
my super is no tax, yeah. The super I get.
No. It's not on your savings. This is not on your savings. Superannuation funds make those, collect those funds
Yeah.
and invest.
I know.
And they earn profit, and this profit will be taxed at 15%. Right.
The
No. Superannuation is not taxed. Sorry. Quit. All right. Annual income 18,200 to 37,000. Your tax rate will be, now personal tax rate will be 19%. And 37,000 to 19,000, 32.5%. Right. 90,000 to 180,000, tax rate, personal tax rate is 37%. Over 180,000, your tax rate is 45%. Right. And as I told you, it changes. Listen to your budget. And it's 2017-2018 financial year. This was the third bracket was 37,000 to 87,000. Last year, 2018-19, it's changed to 90,000. Right. So best thing is to go to the website and get the current rates, government website. That's more accurate. All right. Next one is capital gain tax. Again, as I told you, this is not a separate tax. Capital gain tax is a part of income tax. Right. It is a part of income tax based on the capital gain you earn. Right. Assets acquired since capital gain tax started are subject to capital gain tax unless specifically excluded. So when the capital gain tax started? 20th September 1985. Any properties you bought before that, investment properties, or any properties, they wouldn't be taxed under capital gain tax. Capital gain tax are only on property, mainly on property and real estate, but shares, units, and other similar investments are also taxed with capital gain tax. Leases, goodwill, license, foreign currency, contractual rights, and major capital improvements are also comes under capital gain tax, will be taxed under capital gain tax. And collectibles, personal use assets above a certain value. But these are not our main concerns. Our main concern is property and real estate. Yep.
Will it take into account the CPI and the inflation?
They were taken it before, but not anymore. Let me see. Yeah, I'm trying to remember the name. They considered CPI, but not anymore. No, forget about it. No CPI. That's advantage. Yep, exactly. Right. There are some exemptions to capital gain tax. So, assets acquired before the capital gain tax introduced, they are exempt. It means 20th September 1985. And your main house, your place of residence, principal place of residence is capital gain tax exempt. So you live in your house, you keep it for many years, live there for many years, and you sell it, does not come under capital gain tax. Right. And 50% discount on personal tax rate for any capital gains on the asset held for more than 12 months. You are individual and you bought an investment property, keep it for more than 12 months and sell it and you earn a capital gain. But if you are entitled to have a 50% discount. Individuals are entitled to get 50% discount if you hold the property for more than 12 months. If you sell it within 12 months, you will not get 50% discount. Right. No discount available for companies, that is flat 30% tax rate. For the companies, no discount, even though they keep it for more than 12 months, flat 30%. Trusts are entitled to 50% discount when paying capital gain tax on an asset held for 12 months and then sold. Trust considered as a person in this case. Right. If a trust keep a property for more than 12 months and then sell and gain a capital gain, you get a 50% discount. Right. A motor car vehicle registered to carry a load of less than 1 ton or fewer than 9 passengers, motorcycle or similar vehicles are exempted. Personal use item required for less than 10,000 is accepted. Collectibles acquired for $500 or less, or worth $500 or less when acquired, these kind of things are accepted. Right. Any questions about tax?
So for principal place of residence, how long you need to claim this is your principal home if you don't want to pay tax? 1 year or 2 years?
Good question.
You need maybe 1 year or 2 years or claim.
Good question.
Because I heard someone say 1 year, someone say 2 years, so
I'll
it's
check
very
it.
clear.
Yeah.
Different people.
Probably 1 year, more than 1 year for sure, I guess. Yeah, I'll check it. We will check it on the website. Yeah, good question. All right, then we move to depreciation and capital allowances. We call capital work deductions too. That's an important part of investment. So what is depreciation? And what is capital deductions or capital allowances, capital work deduction? Depreciation. A depreciation asset is an asset that has a limited effective life and reasonably be expected to decline in value over the time it is used. And depreciating assets include such items as computers, electric tools, furniture, and motor vehicles. Any assets which has a life more than 1 year, you can say it's an asset and it's a depreciable asset. Right. That's the definition of Australian Tax Office. And land is an asset which lasts for more than 1 year. Is that a depreciable asset? Is land a depreciable asset? It's an asset, and you use it for your business purposes. Yeah. Land doesn't depreciate. Land always appreciates. So lands are not entitled for depreciation. Okay. Land and items of trading stock are specifically excluded from the definition of depreciating entity. For example, what is that? Trading stocks for cars, machineries. Why they are exempt from depreciation? Because if they are a trading asset, that's a good. That's a stock. They don't use this for business purposes. Right? That's their business selling. So that's a different story. All right. Purpose of tax depreciation. What's the purpose? To provide an incentive for business and investment expenditure. If you have done financial basic accounting, if you have seen a profit and loss account, you can see depreciation. Is depreciation an actual cash flow? No. Depreciation is not a cash outflow. Right. You don't pay depreciation to anyone. Right. It's the allowances which allows you to reduce your profit. For companies, profit and loss account, company can use different percentage. But for the tax purposes, there are different percentage. Some companies, they have a similar same percentage. That's easy. If the percentages are different, you have to add the company's percentages back to the income and subtract the tax office percentage to calculate the profit for tax purposes. Right, that's something extra. Right. So since depreciation is not an actual cash flow, it is an allowances for you to reduce your profit. Right. So when you calculate the depreciation, every asset has a limited lifespan. Depend on the equipment. Furniture, fitting, lightnings, vehicles, machineries, computers, they have different lifespan. Right? So we divided the value of each asset during their useful life. We call effective life. Right? Then we calculate the depreciation rate. Right. What is effective life? Should be somewhere. What is effective life? Effective life is how long it can be used by any entity for a taxable or non-taxable purpose, having regard for reasonable wear and tear in the relevant years, assuming proper maintenance, and having regards for property within which is likely to be scrapped. Right. So in financial accounting, this is something extra. We do depreciation, we calculate depreciation, and we put that money in a different account. We call accumulated depreciation account. Right. So some companies use that accumulated depreciation account as a sinking fund. Get the similar amount of money and take out and put into a sinking fund account to create a fund. So when that asset is about to expire, limited lifetime is over, so they can use that fund to replace that asset. Right? So depreciation is allowances to get more money to get that asset back when the total lifespan is over of the existing life. Right. What is capital works deduction or capital allowances? So we talk about depreciation. Depreciation is only for assets, but not for the buildings. And then why not building? Building is a fixed asset and it has a limited lifetime. Probably could be 50 years, 60 years, 70 years, 80 years, 150 years. They depreciate. Why can't we claim building? Why can't we depreciate building? We can, but we call it capital allowances. Just a different naming. We still do the same with a different naming. Right? We call it capital work deductions or capital allowances. But for taxation purposes, we have a separate fixed percentage for capital allowances. We talk about that, 2.5%. Right. Capital work used to produce income, including building and structural improvements, are written off over a longer period than the other depreciation asset. Normally throughout the 40 years, first 40 years. The capital work deduction is available for building or extension, alterations or improvements to a building, or structural improvements such as sealed driveways, fence or retaining walls. Earthwork for environmental protection such as embankments. Those comes under capital works deductions or capital allowances. Again, land itself can't be written off as cost isn't deductible. Right. Land itself doesn't depreciate. Yep.
For the improvement, that's capital expenditure.
Yep.
So when we make a capital expenditure, when we spend that money in year one, that's an outgoing. So I deduct that from my taxable income. And then throughout the lifespan, I deduct a little bit depreciating.
Yep. You can't deduct full amount. sorry, you spend cash outflow at the first year, say 500,000, but you can claim throughout the 40 years. If it lasts for 40 years, you can claim that amount.
So even
It should
if
be-
I spend 200,000, that's not deductible.
That's a cash outflow in DCF. It's minus. Right. We'll do cover when you do discounted cash flows. Right? I'll show you how to do it. Right. Effective life. Right. Deduction for the cost of depreciating assets. Under income tax law, you are allowed to claim certain deduction for the expenditure incurred in gaining or producing accessible income. For example, in carrying on a business. This is I got from Guide to Depreciating from Tax Office. Some expenditures, such as the cost of acquiring capital assets, is generally not deductible. Generally, the value of the capital assets that provides a benefit over a number of years decline over its life's effective life. Because of this, the cost of capital assets used in gaining accessible income can be written off over a period of time as a tax deduction. Right. Example. Property investors are allowed to deduct the depreciation allowances follows in value of their asset, as well as loan repayment from the net operating income, to derive that their taxable income on which their tax payable is calculated. Right. Your net operating income is 150,000. Right. Now, the first case, we include depreciation. Right. Net operating is 150,000, and loan repayments is 50,000. Right, not 5,000. It's 50,000. I miss 10. And depreciation, we allow depreciation 50,000. Sorry, 25,000. Remember, depreciation is not an actual cash outflow, but that is an allowances. Right? So we allow companies to deduct depreciation. So in this case, 25,000. So your total taxable income is 25,000. So the tax rate is 30% since it's a company. So you pay 22,500 tax, and your net cash flow is 77,500. So if you don't use that tax depreciation, what will happen? Your net operating income is 150,000, and your loan repayment is still 50,000, and you don't claim tax depreciation because you don't know about tax depreciation. You didn't claim. Your taxable income is 100,000. Now you pay 30% on tax, which is 30,000. So now your remaining net cash flow is 70,000. So since you keep tax depreciation, so you use that allowance as 25,000, and you have higher cash flow. So that is the allowance from the government to run a business in an effective way. Right.
Also, your loan repayment, you miss out on zero.
Yeah. It should be 50,000, not 5,000. Yeah, sorry. All right. Tax depreciation and capital allowances. Again, net rental 100,000, recoverable outgoings 20,000, total outgoings 30,000. So your total net operating income 90,000. Depreciation capital allowances 15,000. So your taxable income is 15,000. What is the effect that depreciation and capital allowances have on the amount of income tax paid? So now calculate the tax, say is 30%. 30% on 75,000, around 25,000. Right. If you did not use these capital allowances, you had to pay a tax on 90,000. Right. Simple. All right, effective life. So we talk about the depreciation rate and depend on the effective life. So carpet, normally we consider carpet as 8-year effective life, 8 years effective life. Fire extinguishers, 15 years. Hot water system, 12 years. Hot water system, solar panel, 15 years. Windows, wall, roof, it means capital works. Structural work has a 40-year effective life. Right. Right. Now, how do you depreciate the asset? Methods for calculating depreciation. There are different methods. There are different methods, 4-5 methods, 3-4 methods. There are two main methods, prime cost method and diminishing value method. Right. Prime cost method means you depreciate the asset in a certain percentage every year. 10% or 8 years or 10% or 5% or whatever the percentage every year said. Right. So, say structural work, roof, effective life is 40 years. And what's the depreciation rate? How do you calculate the depreciation rate?
2.5%.
And how did you calculate it?
Use 40 divided
So effective life is 40 years. Then what's the depreciation rate? How did you get it?
So I calculated per annum depreciation amount, which is 2,500. 2,500 is 2.5% of 100,000.
Okay, you get that way. Right. What's the easiest way to calculate the depreciation rate? 1 divided by effective life. 1 divided by 40. Right? 1 divided by effective life. So you get a depreciation rate as a percentage. Clear? Simple. So then 2.5% multiplied by 100,000, 2,500. Is that right? Yeah. So what's the effective rate, depreciation rate for fire extinguisher? 1 divided by 15%. 1 divided by 15, sorry. 6.6%. And what's the depreciation amount per annum? 6,600, sorry. 660? Yeah. So then we depreciate this amount, 660 will be the depreciation amount for every year. That's what we call prime cost method. We depreciate the asset with the same amount every year. So at the end of the lifespan, the value of this asset will be 0. If you use the prime cost method, the remaining value at the end of the life, effective life of that asset will be 0. Right. What is diminishing value method means? There are some assets, especially machineries, they have a higher productivity, higher usage at first few years, but at the end of the last years, at the end of its usable life, they don't produce that much as they produce what they produce at the beginning. Right? So their value is diminishing. So when we depreciate higher amount in first few years, and we will depreciate lesser amount in last few years. How do you calculate? Calculate the effective life, get the effective life, for example in here 12 years, and 1 divided by 12 years, and then we multiply by 200%. right? That's a percentage. So effective life is 12 years, and we are calculating diminishing rate. 1 divided by 12. What's the rate?
5%.
Sorry?
2.5%.
1 divided by 12?
0.83.
Yep.
Yeah,
8.3%. Right. And then multiply it by 200%. It means multiply by 2. 16.6. Am I right? 16.6. So that's the depreciation rate. And how do you calculate the depreciation value then? We calculate, say its value is 50,000, rate is 16.7, and what's the depreciation amount? 8,350. And next year, the remaining value is 50,000 minus 8,350. What's the value? 51,750. Right?
41?
Sorry, 41,750, sorry. 41,750. Then we multiply, calculate the depreciation amount that based on that 41,750. Right. In prime cost method, we get the original price, cost, and use this rate, depreciation rate for based on that purchase price, original value. On the diminishing value method, we calculate the diminishing value every year. Original price, subtract the depreciation of that year, and get the diminishing value. And that's the original value of the following year.
So it's like reverse compounding.
Yeah, we can say that. You get the idea. Yeah. Right. So every year. So in that case, the first year, the depreciation amount of the first year is higher, and the second year is lower, and third year is even lower. And the depreciation amount is gradually lowering. But in this method, it will never become a zero. At the end, it will be few cents at least. Right. Good. Those are the two main depreciation methods. Yeah.
For your effective life, right, given that you hold, for example, the asset for year 2, your effective life would be 11 years, right? Is that how you do it, or you just maintain the 12th year?
No, we don't need really this. We get the depreciation rate now. We use that rate.
Yeah, correct. So I'm saying that when you were to calculate, if you were to hold the asset for for year 2, but how do you go about calculating out the depreciation amount? You base the amount on 41,000.
41,750 multiplied by 16.7%.
Oh, so the 200% over 12 year, which is the 16.7%, is constant throughout.
Constant throughout, yeah. Depreciation rate is constant. Once you calculate, it's constant. We don't change the rate every year. Yeah. All right. Method for calculating depreciation, which method to use? So how do you choose which method to use? For depreciation of plant and equipment, either method is applicable. You can choose. For capital works deduction, you must use the prime cost method. You have no choice. You have to use prime cost method. What are the depreciation rates? 2.5% per annum for construction between 1979 to 1984. If that building, capital structural work built in between 1979 to 1984, the depreciation rate is 2.5%. And if your building built between 1984 to 1987, its depreciation rate is, capital allowances rate is 4%. And your building is built after 1987, again, your capital allowances rate is 2.5%. So it means effective life is 40 years. Assume. All right, next one. Calculating capital gain tax. How do we calculate capital gain tax? This is important. We talk about tax depreciation, capital allowances, and everything. Now we came to the last. Think about our investment. After 10 years investment period, for example, we sell our investment in higher value. We gain a capital gain. Now we have to pay capital gain tax on our capital gain. So how do you calculate the capital gain tax? Right. Payable on assets acquired after 19 September 1985. So that's where that capital gain tax introduced, when the capital gain tax introduced. Post September 1999, capital gain tax are not CPI, but a 50% discount applies where personal tax rates are used. Okay. But not where company or superannuation tax rates are used. Right. So now it's not CPI. Depreciation and capital allowances claimed during the ownership period is subtract from the cost base. Cost based is important. When you calculate capital gain tax, you have to calculate the cost base. What is the actual cost of your asset or your property? Any capital losses are quarantined and may be offset against the future capital gain. If you actually didn't earn any capital gain, you bought it for 1 million and you had to sell it for 900,000, it's a capital loss. You can brought forward it to future years to set off with your other capital gains in your portfolio. Right. You don't have to pay tax. Right. How we calculate the capital gain tax? That's important. Think. You bought a property and you keep it for 10 years. Right. And you deduct depreciation and capital allowances throughout that 10 years. They were not actually the expenditure. They were not real cash outflow. Right? They were allowances. Those tax depreciation and capital allowances help you to pay less tax. Clear? Using capital allowances and depreciation, you pay less tax. But at the end, when you sell your investment, you have to adjust. You have to calculate all the capital gain, capital depreciation amount, plus tax allowances you have claimed so far, and adjust it the capital base. Adjust the capital base. It means you add them back. Simply your value will be, your sales price will be higher, or otherwise your cost base will be lower. Right. You enjoy the capital allowances and the tax depreciation, you pay less tax, you have a good cash flow. But at the end, you have to pay for that. Right. At the end of the investment period. Clear? We'll do it. Calculating capital gain tax. Your total capital gain for the year, subtract. Your capital losses for the year and any unpaid losses from the earlier year, subtract. Capital gain tax you are entitled to. Right, for example, simple. Tax rate is 45%. Net sale proceeds 1 million. Initial purchase price 500,000. So how much is the capital gain? 500,000. But 500,000 is not the actual capital gain, right? Because you have already claimed depreciation and capital allowances on that property. For example, you have claimed 100,000 as a tax depreciation and capital allowances. So we normally reduce that from your purchase price. So your total cost base is 400,000. And what is the actual capital gain? It's not 500, it's 600,000. Basically, we add this total depreciation and capital allowances to your capital gain. Clear? You enjoyed this 100,000 throughout the last 10 years, but at the end, you have to pay tax for those. Because you didn't pay tax for your tax depreciation and capital allowances. Right? Clear? It was an allowances for you to run the business well. And now you make a capital gain. You made a capital gain. Now you have to pay tax on that allowances you claimed so far. So in this case, your capital gain is 500,000 plus add these capital allowances. So it's 600 at the end. So normally what we do is we calculate the cost base. It means 500,000 minus that 100,000. Purpose of that is to increase the capital gain. Right? Capital gain is 600,000, and since you have keep it more than 5 years, more than a year, you get 50% discount. So your total discount is 300,000, and your net capital gain is 300,000. Pay tax on the 300,000. Right. If it is a company, 30% rate, it means company. Same example, capital gain tax is 600,000, no discount, you have to pay tax, capital gain tax on full 600,000 at 30% rate. As you can go through, this is the method you use it.
What about trusts?
Trust, if the trust distribute all their profit to the trust holders, no tax. But if trust keep the profit with them, tax rate is 45%.
45. Same as first.
Is it 45? Yeah. Yeah.
Can you be the sole owner of the trust?
Sorry?
Can you be the sole owner of the trust?
Not quite sure. I don't think you can be sole owner. No. I don't think. No. Then what's the point of creating a trust?
Sorry.
What's the point of creating a trust then? To get the tax benefit?
To get 0% tax. You can save yourself, what, $135,000?
I don't think they'll allow you to do that.
Yeah, I
Yeah. But, yeah.
I think you can, but it's like, it's considered as,
That's why people create family trust
yeah.
with your family members. So it's like you. Yeah. Try. Good. All right. And we have a calculation example I have uploaded into the LMS. Week 6 copy of DCF step-by-step investment analysis, right? So these are the information. Before I go through that, can I go back to the last week lecture? Can I just go to the last week lecture, please? So last week, at the end, we did the just give me a second. So few students had a question, but yes, last week calculation. I'll just talk about it for a while. All right. I just want to make something clear what we talked in last week, right, before we start this week calculation. All right, we are in last week. I forgot her name. This is last week calculation, DCF, right? Problem was, I think I used the wrong word. We calculate the present value using after interest, right? After interest net cash flow does not represent the value of the building. At the beginning, I told you we use discounted cash flow for two main reasons. One is for the valuation purpose. The second one is for the investment purposes. Right. For the valuation purpose, our discounted cash flow finishes here. Right. When you value any property, income generated property using discounted cash flows, our discounted cash flow finishes here. Right. Then we calculate the net present value of future income. That's the value of the building. We calculate that. NPV. So net cash flow before tax and interest, right? Before tax and interest. Oops. Yeah, sure. What's the rate? 8%. Is it 11%? Yeah. So now this is the valuation. 4.5 million. Right. Because it is right, we can see it. Our purchase price is 4 million. And our discount rate was 11%, but actual IRR is 15%. So it means we get more than what we want. So it means the value is more, should be more than what we paid for. So we paid 4 million, but it's worth 4.5 million. So this is the value. When we calculate the valuation, we always use a net present value before tax and interest. That's the value of a property. Yeah.
So you're saying this the loan repayment line includes interest? So is that essentially what you're saying? So the loan repayment line,
Loan repayment, that's the interest payment.
and then it feeds down to the end.
Now if you get this one, it doesn't make sense,
Yeah, it was just
right? It's just a net cash flow after interest. That's it. It's nothing to do with the value of the property. So my financial sources might be different from your financial sources. You might use 100% equity. I might use 90% gearing. Right? I'll get a higher return, you get a lower return. But it should not represent the value of the property. That's how we finance investment. Right? So value, which the profit or income generated from the property should be the same regardless our method of finance. Right? So if you include these ones, loan repayment plus tax, it doesn't represent the value of the building, value of the property. Right? So when you calculate simply, when we calculate the value of any investment property using discounted cash flow, we get the net present value before tax and interest. Right? I think last week, I think this is the value. If I say it, it's a mistake. Sorry. Right? So we always calculate before tax and interest to calculate the value. Okay? So now, but the second part, I say, our purpose of the DCF is to see this investment is feasible for us. Then, of course, we had to calculate the loan, interest, and tax. For that purpose, yeah, we have to get everything. Clear? Yeah. Right. Do you have enough time? Let's see. All right, go to the today's one. Lecture 6. So, I don't think we have time, but you do it by yourself when you get home, and I'll put the answers. So no, otherwise we will do this in a tutorial class. Right? So these are the basic information. Listen. All right. Purchase price is 4 million. Initial net income is 350,000. Initial cap rate is 7%. All the basic information we used before. And discount rate is 11%. Terminal cap rate is 8%. Purchase expenses is 6%. And sales expenses is 2.5%. Rental growth per annum is 4%. And rent review is 2 yearly. Right? So, term loan to value ratio is 70%. So you get 70% of 4 million. And interest rate is 8%. So you assume you only pay interest only loan. Right? Don't worry about the amortization. Right? You only pay interest only loan. Interest rate is 8%. And then incorporate the tax. We did this part before. Now these two are the new. Right? So listen. 75% of the total asset is building component. So building component of the total asset is 75%. So total value of the asset is 4 million, and 75% of that 4 million is the building. Right? And 20% of that building is, I would say, asset A, which has a depreciation rate of 9%. Right? 20% of the building component is asset B, which has a depreciation rate of 6%. Right? Total 60% of the building component is asset C, which has a depreciation of 2.5%. I would say it's capital allowances. So 60% of this building component is capital allowances, building structural work, right? Structural work which depreciate as 2.5%. This is a really good example which you'll be tested, kind of. right? So the 20% of 75%. Clear? So total price, I'm explaining you again, total value of the building is 4 million and 75% of 4 million is building component, which is 3 million, right? 20% of that 3 million is asset A, which will be taxed at 9%. 20% of that 3 million will be asset B, which will be taxed at 6%. And 60% of that 3 million is structural work, which will be taxed at 2.5%. So calculate the tax depreciation and capital allowances for the 10 years.
The tax rate 9%, 6%, which tax? What kind of tax?
Depreciation rate. These are depreciation rates. Did I say tax?
It's depreciation.
These are depreciation rates. Sorry.
Or tax rate.
Did I say tax rate? Sorry, these are depreciation rate. Did I say tax rate?
Yeah.
Sorry. Sorry, I'm sorry. These are depreciation rates. I'll tell you again. 20% of the 75% in 3 million is asset A, which depreciate at 9%. 20% of 3 million is asset B, which depreciate at 6%. 60% of the 75% is structural work, which has a capital allowances of 2.5%. Right? These are rates, depreciation rates, right? And then calculate the total depreciation allowances. I have given you the structure here, so.
Is it prime cost or diminishing value?
I'll go to prime cost. Don't
That's
worry.
also a straight line depreciation. It's the same
Yep.
thing, right?
Same thing. Right. And then calculate the capital gain. Calculate the capital gain and capital gain tax. Right? Since this is 30%, what sort of entity is this? It's a company. Using tax rate, looking at the tax rate, you can say it's individual or trust or what, or company. 30% flat rate is straight away it's a company, right? So would you get a discount? 50% discount on capital gain tax? No. Looking at, in the question, it wouldn't say this is a company, but looking at the rate, you need to understand it's a company, and then what are the implications on capital gain tax, right? No 50% discount. And right, cost base. Your initial cost is 4 million and subtract all the capital allowances you have claimed so far and depreciation. Right? And then allowances claim, then you get the adjusted cost base. And then net sales price, get it from somewhere here. Net operating income divided by cap rate, terminal cap rate, get the net operating income, and then calculate the cap rate, capital gain tax. And then calculate the capital gain tax and get that capital gain tax here as a tax outflow at the end of the 10th year, tax payment. You save money, save tax throughout this 10 year, but at the end when you calculate the capital gain tax, you have to add them back. Right. Clear?
When we are calculating the value of the property in year 11, do we also subtract depreciation from the net operating income and then calculate the value on that?
Yep. Because we can claim tax depreciation even for the last year too. But to the year 10, not to the year 11, sorry. Our investment period is year 10 years. We do it for year 10, not to the year 11.
So to get the value of the property,
If you get the year 11,
just use reverse cap rate from year 11,
Year 11. But
without the
yeah, no tax depreciation because we don't hold the property for like year 11. Right. Yeah.
Depreciation, what asset are you using? Capital depreciation?
From prime rate. Prime, yeah. Make it simple.
For the cost base, do we have to include all the costs when we buy and sell the property, and also including the exchange rate holding for the interest payment or
Yep.
interest payment?
Interest payment is different. That's actual payment.
So which will be including the cost
Tax allowances, capital gain allowance, capital allowances plus tax depreciation. Interest is actual payment, but depreciation and capital allowances are not actual cash outflow. It was just an allowances to pay less tax. Confused?
Because actually, finally, if we just calculate the capital gain, we have to adjust for the capitalization allowance, right?
Yeah.
Together in the 10 years. For the interest rate cost, do we have to
Now, interest is actual payment. We paid it to the bank. It's actual cost. You don't have to adjust it. But tax depreciation plus capital allowances, they are not actual payments. We didn't pay for anyone. They are just an allowances. That's just a normal deduction without any payment to pay less tax.
So we when we just do the adjustment of cost, we just to use the cost when we purchase the property and the feasibility and just over the capitalized already. This is 3 parts.
Yep. Right? So do it by yourself. I'll put the answers on after, probably before next week. So then you can double check. If you still couldn't get it, we will do this one in the tutorial. We'll find a time. Right? All right. Any question? I'll stop this.
Can I ask a
Yeah, just give me a second. I pause. Okay.